Here we are, Friday, August 29th, the last Friday of real summer. 2 weeks ago, I was distressed and depressed. And last week, I was almost exuberant at the data coming by. Today, it's tough out there, but I don't want to overstate the alarm, especially here in the United States. We're very fortunate here. We have achieved more fiscal balance here than any other major region in the world, which protects us. We're not borrowing as much money. We've got trouble in the labor market. Incomes aren't rising as much as they should, but we are in the best shape of any major region in the world. But the outside has impacts here. For the time being, they are beneficial to us. They're pulling down interest rates. The mechanism by which they do so and the extent of alarm overseas is hard to explain, but I'm going to try. This week, the yield on German 10-year bonds fell to 0.89. Low rates are good, right? Not if they signify a depression or worse. The very peculiar aspect in Europe, and especially in Germany, is the European Central Bank is attempting to weaken the euro and has dragged the value of the euro down by about 2% of its value so far this year, from $1.40 to $1.31 today, and expected to go lower. The ECB meets on Thursday, is expected to do something very dramatic. I don't know anyone in the markets thinks it will do any good, but the evidence is so tough that they're going to have to at least pretend to act. In the world of currencies and bonds, money goes to bonds for safety. Money also goes to currencies for safety, and the euro is one of the strongest safe havens. If there's trouble in the world, buy euros. Given the drop in the value of the euro, buying a German bond for safety costs you 4 percentage points per year. The two theoretically cannot move together. You can have a strong drop in the value of in the yield on a German bond, but at the same time, the euro currency should be rising in value. That's a mechanism in Japan and in the United States. Here in the US, the dollar is rising in value, and our bond yields are going down as money comes here for safety. The completely weird aspect here in the United States is the Fed is about to begin to raise interest rates, which means no one should buy US bonds. These, not just counter-theoretical, but impossible market conditions are an indication of stress that we don't feel. You don't see it out the window. The lights come on at night. Business is still good. Parking lots are full with customers. Data could be stronger, but it's okay. And yet there are tensions in these financial markets, as old as I am, I've never seen before. And I'm not quite sure what they mean, but I can't underestimate or underemphasize the magnitude of the tensions. And with that, have a nice Labor Day, and we'll see you next Friday.